Hi everyone. Welcome back to the investment banking series. So, as discussed, we will be starting with our accounting questions. So, first, we will be starting with our basic questions. So, there are 34 questions, and I will make sure to make smaller videos so that it's easy for you guys also to watch and uh, easy to grasp the concepts. So, without wasting any time further, let's get started. So, the first question. So, majorly in interviews, it's asked by an interviewer to walk through the three financial statements. And at times, the candidates are not aware how to answer these questions. So, the basically three the three the major financial statements are income statement, balance sheet, and cash flow statement. And also, we have previously using the Apple company's example. We have seen that the three statements are statement of statement of operations, balance sheet, and cash flow statement. So what they are trying to assess here is how much well versed are you with your concepts, and are you regularly practicing these concepts or not? So the three major financial statements are income statement, balance sheet, and cash flow statement. The income statement gives the revenue and the expenses part of the company, and it ends at the net income part. And after net income, earning per share, diluted and basic, is calculated along with the number of shares. So the second statement. Let's talk about the second statement. The second statement is the balance sheet, the company where it shows the assets and its liabilities along with its shareholders' equity. So assets are actually the resources of the company. Liabilities are the liabilities which the company is liable to pay in future, long term, short term, anything. Shareholders' equity is the portion of equity which is the which represents the ownership in the company. And as the golden formula, the golden rule, assets must equal to liabilities plus shareholders' equity. The third statement is cash flow statement, where the statements begins with net income. Then we adjust the non-cash expenses and the working capital to drive the cash flow from operations. And the other portion are cash flow from investing and cash flow from financing. And in the end, the company's net change in cash is calculated using the cash flow statement. Second question. Let's move to the second question. This is a question asked by interviewer to check how much knowledge do you have about the line items, the listings on the financials. So income statement has the line items, revenue, cost of goods sold, SG&A, selling general and administrative, operating income, pre-tax income, net income. Balance sheet has cash, accounts receivable, inventory, plants, property and equipment, accounts payable, accrued expenses, debt, and shareholders' equity. And cash flow has these line items, these listings: net income, depreciation and amortization, stock-based compensation, changes in operating assets and liabilities, capital expenditure, purchase of securities, dividend issues. This you can also find in the financials reported by the company. So here, if you look at the financials of the company, so net sales in the income statement, net sales, total net sales, cost of goods sold, total cost of goods sold. We subtract the cost from the revenue. It gives us margin and the other expenses, operating expenses, research and development, SG&A. These are the total expenses. We subtract these expenses from the gross margin, operating expenses. We get the operating income. Other income, then we adjust for other income and expenses. Then income, we get the income before provision for income taxes. And after that, we reduce the provision for income taxes and we get the net income. And after net income, there is EPS and total shares. For balance sheet, the major line items are cash and cash equivalent, marketable securities, account receivable, vendors, non-trade receivables, inventories, marketable securities, PPE, for liabilities, accounts payable, deferred revenue, commercial paper, and for non-current liabilities, term debt, other non-current liabilities, and shareholders' equity here. For cash flow activities, these are the major line items. Investment activities, these are the major line items. And for financing activities, here, payment of taxes, payment of dividend, repurchase of common stock, proceeds from issuance of term debt, repayment of term debt, repayment of commercial paper. Now understand this thing. This might be a very easy question, but what they actually want you to understand is what actually they are seeing, what they are assessing is whether you are able to place the right items under the right head. So if you are aware about the cash and cash equivalent, so you will never place it somewhere in the non-current assets or current liabilities. Cash and cash equivalent is a part of current asset. If you are aware about if you understand the feature of the asset, if you understand the feature of the listing, so you will place it properly under the correct head. Marketable securities, these are current assets. Account receivables, these are the current assets. The account receivable can never be current liability or non-current liability or non-current asset or under shareholders equity. Account receivable can never be under shareholders equity. So when you are answering these questions, please be aware about your knowledge and just be cautious. Whensoever, whatsoever you are saying, just be cautious. Just analyze it through within your mind first, then you speak. Operating income activities, the listings are easy to understand, but the listings in investment activities, purchase of marketable securities, proceeds from maturities of marketable securities. See the nature here, marketable securities. If you are purchasing marketable securities, this cannot be under financing activities. Marketable securities represents you are purchasing something, so you need to understand the nature. So in that's why it's under investing activities, because if you're purchasing something for the future, it will be considered as investing. Proceeds, you have received some money where you have previously, the previous markets of securities, these are the proceeds. So investing numbers are majorly negative and then cash inflow are positive in investment activities. So here it represents a positive investing activities represent that the company had a more inflow than the outflow. So they have invested lesser this time. In this quarter, if look by looking at these numbers, the company has lesser investment this quarter. Financing activities. Now understand the finance nature of these listings. Payment of debt, payment of dividend and dividend equivalent. Previously, they have raised capital, they have raised equity, and now they are paying dividends. And they, because equity they have raised, it would have come under a financing activity. Now they are paying back the dividends for the equity raised. Repurchase of common stock. They have repurchased the common stock. Repayment of term debt. The debt they had raised. Now they are paying back principal portion for the debt, repayment of commercial paper and others. So you need to be very well aware about the listings. Now let's move to the next question. How do the three statements link together? So the three statements are linked together. Let me show you with the example. Previously also we have talked about this. So the net income here, 23,434 or cumulatively 84,544, it will be linked to cash flow statement net income because these are cumulative numbers, and always be aware about, always pay attention to the numbers. These are cumulative and these are quarterly numbers, and also the dates. Never be confused or never skip checking the dates, because at times what happens is these numbers are reported first and the current quarter numbers are reported second. So you need to pay attention to those numbers and dates and everything. Just pay attention, just be detail oriented. Because in finance, when where money is involved, there the chances of losses should be zero. So like for the first link was we have linked the net income to the cash flow statement. And second point is the cash flow, the cash and cash equivalent will be linked with the cash and cash equivalent at the end of the period. What the answer is indicating here is the changes in balance sheet items appear as working capital changes on the cash flow statement, and the investing and financing activities affect balance sheet items such as PPE, debt, and shareholders' equity. The cash of shareholders' equity item in the balance sheet acts as a plug the cash flow from the final line of cash flow statement. This we have covered. The second point where they're talking about the balance sheet of cash flows, the working capital changes that we will do when we will be doing the example. So the third question is fourth question. So which one statement will you look if you're stranded on a desert? Because income statement and balance sheet are used to prepare the cash flow statement. If they are giving you just one report, one statement, so always ask for cash flow statement, because cash flow statement gives you the true picture, and income statement and balance sheet are used to prepare cash flow statement. So that's why cash flow statement will be the only statement. If you were given one option to choose only one statement, then you will use cash flow statement. And if that option is two statements, then you will use income statement and balance sheet, because you use to create cash flow statement from both of these statements. So if two statements you need, so then you will need income statement and balance sheet. Now this is the interesting question. Now the question is, walk me through how depreciation going up $10 would affect the statement. So if the depreciation is increased by $10, how it will affect the three statements. Now for this, let me share my Excel with you, which I have prepared for you. And I have not put in any numbers because I wanted to do this live. So I'm assuming that the revenue of the company was $1,000. And let's assume that the 300 was the cost of goods sold. So the gross profit was $700. I'm assuming an SG&A of 100. So the operating income will be 600. A depreciation. So because the depreciation is increased now, so earlier let's assume the depreciation was 90 and amortization I'm assuming negligible. So the EBIT will be 510, and at a 40% tax rate of 204, the net income will be 306. And how do I link these numbers? So question 1 to 5, and this question number 6. So how do we link these? Because the net income is 306, we will go to the cash flow statement now. So cash flow statement, this is linked 306. But there was a depreciation of $90 here. We have put in a depreciation $90. We will add it back next. Because it's a non-cash expense, we need to add it back. So the operating activities will represent 396, and I'm assuming nothing else has changed. Depreciation will be charged on PPE. Now, this is where you need to pay attention because depreciation is $90, and I am assuming that the PPE was $1,000 earlier, and now because $90 was subtracted from it, so PPE is left with 910 only. PP after subtracting $90, PP is left with 910 only. And initially it was $1,000. This PP earlier it should be $1,000. Now the PPE after depreciation it is $910. And this is giving us the PPE 1,000 and minus of 90, 910. Don't I understand that this I have not put a negative sign in front of it. It might be confusing, but understand what I'm trying to tell you. The BP amount has decreased. If I am assuming that nothing, we have no further investment, no financing activities, total change will be represented at 396. Now, 396, the shareholders' equity will be linked here, and the cash at the end of the period will be linked here. So basically, my PPE has reduced by $90. So this is what actually I wanted to show you. So if I am not using $1,000 here, if I'm using $1,000 here of PPE and I'm using $910 of $910 change here, but I'm not looking in the numbers because previous numbers we do not have. I'm looking only at the changes. So here the changes are minus 90 and I'm assuming no PPE. So just to give you an estimate. So that's what I have prepared. So cash and cash equivalent was linked here. The second thing, depreciation of from the income statement was linked here. Net income was linked here. And the cash and cash closing was linked here. Now again, now back to the question. If the depreciation is reduced by $10 and the other numbers, depreciation is increased by $10. And if other numbers are same, I'm increasing the depreciation by $10 only here. I'm increasing depreciation by $10. And I'm assuming again amortization is zero. So my EBIT has decreased by $10. First, EBIT decreased by $10. Now, second, because of the tax effect, tax is reduced by $6. Sorry, tax is reduced by $4 and net income is reduced by $6. Now, the second finding here is my net income is reduced by $6. Net income is reduced by $6. So does my operating income will be increased by $4 because tax was reduced by $4. So that this benefit I will receive here. That's what the depreciation does. Depreciation actually reduces your taxable income, the EBIT, and you will actually have to pay lesser taxes. The more you depreciate, the lesser tax you have to pay. The net income component gets lesser also. After that, let's move downwards. So the total change in cash and cash equivalent, because there was an increase of $4. So cash and cash equivalent increases by $4. It will be linked here. So the cash and cash equivalent will be linked, the closing balance will be linked here. And our depreciation of $100 has reduced our PPE by $100. And our balance sheet has matched because also retained earning and accumulated deficit is linked to the income statement. So, retained earning and accumulated deficit, we are assuming that there was no dividend paid. If dividend was paid, then this would have been a different scenario. I hope you have understood what has happened here. Retained earning has, see, there's a difference of $6, and there is a difference of, first, there is a difference of $4 plus 4. So this is a negative difference. It has reduced minus 6. This is plus 4, and this is minus 10. So this will make a difference of minus 6, and this is a difference of minus 6 already. Balance sheet balances here. The net income is decreased by minus 6, and the cash flow from operations, see, this is minus 6, and this is plus 10. So this will make a positive difference of 4. Net income is increased by 4. Net income is increased by 4. So the cash and cash equivalent will be increased by 4. So this is a relatively very easy question, very easy, just to understand, just to have a understanding of the concepts. So this is very easy question. Let's move to next question. So, okay, just read, let's just read first, before moving to the next question. So the income statement, the operating income will decline by $10. And assuming a 4%, 40% tax rate, net income will go down by $6. Cash flow statement, net income at the top, like we talked about it. But depreciation of $10 is a non-cash expense, so we add it back. So the overall cash flow from operations goes up by $4. There are no changes elsewhere. So overall net changes in cash flow goes up by $4. And in the balance sheet, PP goes down by $10 on the asset side. And depreciation and cash flow, because of depreciation, cash flow goes up by $4. All right. So let's move to the next question. Question number seven. So this is a trick question. If depreciation is a non-cash expense, why does it affect the cash balance? Because depreciation is a non-cash expense. It's tax deductible. That's why it affects balance, cash balance. Now look at this question. Look at this. Excel. Depreciation, because of depreciation, the cash is being affected. Because of depreciation, because it impacts, depreciation impacts the EBIT, and EBIT impacts the tax, and tax impacts the net income. That is the reason depreciation impacts the cash and cash equivalent. And also, this also reduces your current value of PP, and we add it back. So depreciation actually, here we add back depreciation, and it actually impacts our total cash and cash equivalent. It actually increases our total cash and cash equivalent. Because why? Because depreciation, even though depreciation is a non-cash expense, this we are adding it back because the concept here to understand is the flow of money. We are saying depreciation, but the money has not flown out of the company. The money is within the company only. So when you are taking account of all the money the organization have, we actually have to add back the depreciation. The depreciation amounts, the money has not left the organization. Because of the provision of depreciation, we are showing this as a negative, as an expense in our income statement, but the depreciation, the amount, the numbers of depreciation in dollars, in millions, in billions, they have not left the organization. That's why depreciation is added back. When you are looking at the cash flow statement, the money did not flow out of the company. That's why. And this actually answers the previous question also. So why cash flow statement is important, and why these two statements are also important if you actually have to prepare the cash flow statement. So let's move to the next question now. Question number eight. So where does depreciation usually show up on the income statement? Depreciation. Okay. Before I answer this question, let's look at this document which was filed by Apple on the SEC, which is a government portal of United States. Here you will not see the depreciation amounts. Conventionally, when you look at the income statement, the in schools and colleges, what the income statement format has been taught. Here, it's not. Um, I mean, the depreciation. I mean, this is not how the companies report their numbers. So, depreciation is actually clubbed in the cost of services or operating expenses. If you have to look into the depreciation numbers, you actually have to go to the cash flow statement. So depreciation cumulatively, these are the cumulative numbers. Depreciation cumulatively throughout the quarter is 8571. So the numbers of depreciation are reported in the cash flow statement because these numbers are added back. So if you prepare the cash flow statement using income statement and balance sheet, so this number should tally. And this is what the question was asking. If Where does the depreciation usually show up on the income statement? It could be separate line item, or it could be embedded on the cost of goods sold or operating expenses. Every company does it differently. Note that at the end of the accounting question. Okay, this is a note that at the end of the end result for accounting question, a depreciation always reduces pre-tax income. So depreciation is used to reduce the pre-tax income. Okay, next question, ninth question. What happens when accrued compensation goes up by $10? So accrued compensation goes down by $10. Let's go back to the Excel and here, if I say the accrued compensation was previously $90 and now the accrued compensation has increased by $10. I'm assuming it 100. So how does it impact our financial statements. Now look at the changes happening. So this is actually changing our cash. Because of accrued expenses, the cash is being changed. The net income is being changed, and the cash, because the net income is being changed, the cash is being changed. Tax actually reduces further on. $10 of accrued expense has reduced our EBIT by $20, has reduced our operating income by $10. Depreciation, I'm assuming to be same. So $10, it has reduced our operating income by $10. EBIT has reduced by $10. And net income is now reduced. Sorry, before that, tax has reduced by $4 because of a 40% tax rate. And net income has reduced by $6. Same goes with the current assets. Same goes with the cash flow statement. Because of accrued expense, because of accrued expense, net income goes by $6. Accrued compensation will increase cash flow by $10. Yes. Net income is down by $10 and overall cash from operations is up by $6. And on the balance sheet, cash is up by $4. So assets are up by $4. On the liabilities, equity, accrued compensation is a liability. So liabilities are up by $10 and retained earnings are accrued compensation. So accrued compensation is increased by $10. Earlier it was zero. Now it has increased by $10. And this will be accounted for here. So these are the things that an analyst has to pay attention to always. So now let's move to the next question. The final question of this episode. So what happens when inventory goes up by $10, assuming you paid for cash with it? So inventory does not impact the income statement because inven unless until the goods are processed, then only it will impact the income statement. The goods are processed and the goods are sold. The cost of goods sold will only be reflected in the income statement. If inventory goes by $10, that's not an issue. If inventory goes by $10, the cash will go down by $10 because this is a cash outflow. And on the balance sheet, inventory will be up by $10, but the cash will be down by $10, so everything will balance. So this was the last question of this episode. I hope you have learned something of value today. And I would really appreciate if you can subscribe to my channel. Stay tuned for the next series, episode 2. We will be discussing about question number 11 to 20 of the accounting basics. And thank you.